Hello, and welcome everyone to the 2020 third quarter investment webinar with the San Diego Foundation. I'm Brian Zambano. I'm our Vice President and Chief Development Officer here at the San Diego Foundation, and I just want to thank everyone for joining us today. These quarterly investment calls are an enhanced service to our donors. These calls provide direct access to our investment leaders in a consistent, convenient, and concise format, so you donors and other partners can remain informed about the performance of your charitable assets. Today, we'll start with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio, our long-term, medium-term, and short-term portfolios, and we'll conclude with the Q&A session. To submit questions, please use the unmute button, the chat function, or the raise hand function in the participants box located on the menu bar below anytime throughout the webinar. Any questions unanswered during today's webinar will be answered via email. And anyone either attending now or in the future can access these slides and recording of today's call on our website at sdfoundation.org, which will be posted by tomorrow. Leading today's discussion will be Kevin Hamilton and Matt Fettig. Kevin serves as a business consultant and advisor in the investment management industry. With more than 30 years of business and investment experience spanning both the institutional and wealth management markets, Kevin has a deep understanding of the asset management business. Most recently, Kevin was a managing director at Rosemont Investment Partners, where his responsibilities included portfolio construction and management, deal sourcing, and evaluating prospective investment. Since 2014, Kevin has served on the investment committee of the San Diego Foundation and is currently serving as the FY20 Vice Chair. Kevin?
Thanks very much. Hello, everybody, and welcome to the call. So we're going to start out with just a little bit of a macro review of where we are now and how it relates to where we've been in the past historically. So taking a look at this first page entitled Annual Returns and Intra-Year Declines, I always say you need to watch out for investment people who throw complicated things to start with at you. So I'm going to explain this a little bit. These are just annual returns for the S&P 500 over this historical time frame. And those red dots below each calendar year are the maximum drawdown which occurred during that time, even though most of the time you can see the S&P 500 had positive returns. So you don't get those positive returns without some level of dip. Now, if you take a look at the current period, which runs through the third quarter of 2020, you see the maximum drawdown this year was an astounding 34%. And you can tell, I'm sure you would agree, that back in March of this year, there were not many people who would have possibly guessed that the market would make up that loss and more, which is exactly what it's done. In fact, we're touching on new highs in the US market as we speak. So a little perspective, that's a very, very rare occurrence. And if you take a look back historically, take a look at the drawdown of 49% and the drawdown of 34% back in the early 00s. Those more or less corresponded with severe bear markets where the market was not able to close positive. You have to go all the way back to 87 to see a period like this where if we had a bear market in 87, it was a quarter-long bear market, very similar to this year, and was relatively short-lived as the economy continued to expand. So one of the things that this points out is the difficulty in really trying to assess the short-term impact of any market dislocation. You don't know for sure how rapidly you're going to come back from that. You just have to assume that you are well enough diversified to weather it appropriately. Next slide. So one of the reasons that we were able to come back the way we did was a very aggressive policy response, both fiscal and monetary, to the COVID-19 crisis earlier this year. And so this slide on the chart on the left gives you a little bit of perspective on that. This is central bank bond purchase activity. And if you look a little closer at it, which is tough for me because I'm half colorblind, but the brown-ish color is the Fed. And I point that out because we know the great financial crisis happened in '09. All the other central banks, although buying less, all the way up until 2020, appeared to be buying some central bank, buying some bonds in the open market. The Fed actually wasn't. The Fed got to a point where they were letting bonds roll out of the portfolio, which means they were letting bonds mature and not repurchasing. Well, guess what? All that changed in 2020 to a level that has never been seen before. So when you think about what has really helped bridge the gap or the valley of uncertainty which occurred because of COVID, it's been the central bank stepping in and providing massive liquidity, which is good, and it's helped the markets recover for sure, but it doesn't come for free. There are costs to any policy response, and one cost to this one, as has happened historically, is I think what Greenspan in the 90s called irrational exuberance. Markets start to realize that, hey, the Fed's going to help bail us out of everything, so we can get in and take a lot of risk and be more aggressive in our investment decisions. So that's what you see a little bit with the kind of market activity in the US that has happened since that time. The slide on the right, number of rate changes by central banks historically, and the blue is hikes, and the brownish color is cuts. So take a look at 2020. Clearly, the policy response across most of the world has been to aggressivly cut interest rates, in addition to the quantitative easing that's displayed on the left side of this page. I only wonder who maybe the sole blue bar is down there who's been hiking into this event. Next slide. So what's been the impact on the bond market and on interest rates in general? So this shows you yield curve changes since 2013, end of the year, to September 30th, 2020. And not only has the Fed left short-term rates very, very low, but the increased activity in the bond market, the quantitative easing, has dramatically brought down rates across the full length of the curve, and also done what we would call flattening the curve relative to the way that it looked in 2013. So much easier to get a hold of cheap money these days, which is great if you're a borrower. All of us borrowers looking to refi our mortgages love what's going on in the bond market, right? Well, the flip side is not so good if you're a saver. And savers are generally retirees, people saving for retirement, and anybody providing long-term capital into the investment market, like, for instance, a foundation. So two-edged sword there, but when you think about where this can go, what makes U.S. monetary policy different than what we can all do as individuals, and frankly, what most countries can do, is that the U.S. is a gigantic borrowing entity that knows they're going to have to be borrowing increasing amounts in the market to cover the fiscal response to all of this. They're one of the few borrowers who can impact, at least to some degree, the rate that they're going to have to pay. And so, nobody knows where rates are going to go, and I certainly wouldn't claim that my crystal ball is any better than anyone else's, but it is fairly hard to imagine rates accelerating quickly off of this level. considering the fact that that would have a very negative effect on what the Treasury is trying to do. So next slide. So how have we been responding to this in the investment program? One thing that we've been doing is, and we've been doing this for several years, increasing the proportion of the endowment portfolio that is dedicated to private equity. Everybody reads about private equity. I don't know if everybody understands what that is, but basically that involves buying companies that do not trade in the public market. And when you put together a program like this, you need to control for a variety of risks associated with private equity. Usually when you invest in private equity programs, you're putting money to work for 10 plus years. So you have illiquid money for that amount of time. The plus is you should get paid for that risk. And because we have a perpetual time horizon in the endowment portfolio, we can afford to have a very long holding period. So that doesn't bother us. In fact, it's an opportunity when we think about how to invest here. Now, that said, there are some natural risks that go with that. You need to build this program out in a way that really helps diversify across a couple of different vectors. One of them is what they call vintage year. If you put all the money to work in 1 year, you are going to be more impacted by what happens economically in the short run. Nobody needs to assume that risk. So we diversify this portfolio actively across vintage years, meaning the year that we invest. And then we also diversify this portfolio geographically by private equity type, that is, what types of companies are being purchased in the program, and by risk level within that. So private equity can include everything from venture capital to growth equity to buyouts and to other categories that are even less risky. And we make sure that we are getting some degree of exposure to all of those things in order to mitigate risk, but also give us the opportunity to earn those kinds of rates of return that you see on the left-hand side of this slide. So the MSCI ACWI is a global equity index, and you can see that private equity over very long periods has handily beat public market returns. That's what we're looking for with a portion of the portfolio, so that we can better diversify our liquid portfolio risk and earn better returns. So I think with that, I get to stop talking and turn it over to Matt Fettig, and he's going to take you through a review of each of the portfolios.
Thank you, Kevin, and good afternoon to everyone. We really appreciate you joining us today. So I will share results portfolio by portfolio with you, and I'll kind of talk in two different formats. One is what I'll call absolute returns. How well did we do in kind of reaching our long-term performance objective? And then secondly, I'll talk in what I'll call relative returns. In relative returns, if you look at the table on the right for the endowment, our returns for the endowment portfolio are in blue. In that shade of yellow, you see the results for our policy index. And you can think about a policy index as an index of indexes that represent each of the sleeves of the pie you see on the left. So theoretically, over time, we want to be adding value by outperforming our policy index. So starting here with the endowment, as Kevin mentioned, we've had a very sharp rebound in risk assets coming out of the lows we hit in March. For the third quarter, The portfolio posted a very strong 6.3% rate of return. I qualify that as both great on an absolute basis and good on a relative basis, as we were able to outperform our policy index. Year to date, January 1st through September 30th, you can see the portfolio was up 2.3%, outpacing its policy index by a fairly large margin. Over the 1-year period, up 8.1%, outpacing the policy index by a fairly wide margin. So for the quarter, and certainly the 1-year period ending September 30th, we've had strong absolute results as well as very strong relative results. For the year-to-date period, certainly weaker on an absolute basis at only 2.3%. And that is certainly affected by what happened during the first quarter of 2020. I'd point your attention to longer-term numbers as well, where they are strong. We're meeting our required rate of return for endowment assets over 5, 7, and 10-year periods, and over 5, 7, and 10-year periods outperforming our policy index. We feel pretty good about the longer-term results. We are proud of them. It has certainly been a difficult slog being a diversified investor, which is what we do, when the S&P 500 has really been the top performing asset over the last, call it 10 years. You didn't need to be diversified over the last 10 years. In fact, you could have owned less than 10 stocks over that period of time, which would have far outperformed the S&P. So I think relatively strong results. So a few things to highlight. What resulted in, and we'll choose the 1-year period, which is a bit of a longer period. We had good results in a number of different places. We have been slightly overweight the US stock market relative to the non-US area. We had particularly strong performance out of our emerging market stock portfolio. We had strong performance out of our bond portfolio. And as Kevin mentioned, we have been building this private equity program for a number of years now. And often what happens in the first few years of building the program is you experience a time at which investment managers are collecting their fee every quarter and every year, but it takes much longer for them to take a private company and accelerate its growth, increase its sales, whatever the objective is for that particular company. And so the value of that company stays the same. The net effect is in the early years, you tend to lose money and private markets tend to detract from your portfolio. But we have reached a point this year where private equity and private credit have started to be quite additive to portfolio results. We don't know if that will continue in the near term, but we expect to reach a point over the next couple of years where the work we have done and will continue to do in the private market space should really help bear fruit for us going forward. So if we flip to the next page, you see the results for the long-term portfolio. The long-term portfolio is positioned much like the endowment portfolio. The one caveat is these funds are all used for grant making, and they can be used by you, our donors, at any time. And therefore, it's not appropriate to invest in less liquid assets like private equity or private real estate. You can see for the quarter and the year-to-date period, slightly behind on a relative basis to our policy index, and over a 1-year period in line. So what has happened here, and why are we underperforming slightly here? you see the 19.4% in alternative investments. The large majority of that is what we call hedge funds. And hedge funds are in this portfolio to help us mitigate risk. Now, if you look at the US stock market, it's fairly richly valued. If you look at the bond market, very richly valued. So how do we protect against owning these overvalued assets? We've taken the approach of adding hedge funds, these alternative assets to the portfolio. Now, we had a very, very large decline in public market stocks earlier this year. That many of our hedge funds were able to protect capital and get that right. But if you think back to Kevin's first slide and you look at how quickly the market has recovered from a 34% drop, what happens with some of these hedge fund strategies is they take a lot of risk off the table in their portfolio, they grow conservative, and when the market does snap back in that short of a period, they tend to get what we call whipsawed. They de-risk their book at a time when perhaps the markets turn around and re-risk. And that is largely what is happening here. Hedge funds can be much more effective if there is a longer term bear market, and that is not what we have seen so far here in 2020. Next slide, please. It's the performance for our medium-term portfolio. The medium-term portfolio has about 30% exposure to stocks and 70% exposure to bonds and cash. So this is a much more conservative portfolio. And if you look at the 1 year number here, it's almost shocking, up 8.3%. That's better than the 1 year number for the endowment or the long-term portfolio, which are taking on a great deal more risk than this particular portfolio. And in reality, it's really just been a perfect storm. As we've had this massive stimulus from both central banks and governments, we've seen interest rates decline significantly. As interest rates decline, bond prices go up. And that is exactly what happened in this portfolio. So the 30% exposure to stocks recovered with the market, and bonds have really just had a once in a lifetime, I'd like to think, though it has happened a few times over my career, environment where rates have declined, bond prices are up, and this portfolio has done extraordinarily well. I would not think that we will repeat a year like this, an 8.3% type of return, particularly with interest rates as low as they are. There's not a lot more room for them to fall. And then finally, we go to the next page, our short-term portfolio. So our short-term portfolio is designed for donors that are not looking to take any risk whatsoever with their charitable fund dollars. And it used to be, when interest rates were in more of a normalized environment, you could earn a income on your savings account, on your cash, CDs, money market funds, etc. Now remember, earlier this decade, interest rates did plummet following the great financial crisis, and it took a long time before the Fed started raising short-term interest rates again. We started to see some yield creep back into this portfolio as a result of those short-term interest rate rises. But as the Fed has cut rates essentially to zero, you can see over the last quarter, 9/30/20, a 0% rate of return for this portfolio. As long as short-term interest rates are sitting at zero, we would expect this portfolio to earn zero. If you are a donor that is willing to take some risk with your capital, stay tuned for a short pitch we'll be making to you here momentarily. But if you are a donor that's unwilling to take any risk with your charitable dollars, it's important to understand that this is not just a phenomenon taking place at the San Diego Foundation. This is a global phenomenon where in some countries you have to pay a yield to hold your money in cash. And so it's just a very, excuse me, unique environment that we find ourselves in almost for a second time in a decade. Now, if you recall at the beginning of this year, we launched 2 new investment portfolios, and I'm proud to say they're off to a very, very strong start. I wouldn't read too much into it, given it's only 9 months of investment performance at this point. But we launched a sustainable endowment portfolio and a sustainable non-endowment portfolio. The sustainable element within the name indicates that these portfolios are following what are called ESG criteria. ESG stands for environmental, social, and governance. So the investment managers in this portfolio are both screening out companies that are not good for the environment, socially poor, or have poor governance standards. And in some cases, overweighting or emphasizing companies that have good standards in each of those 3 areas. These portfolios also take the E, the environmental part, one step further by requiring that the investment managers divest from fossil fuel producing companies. And as you can see here, our sustainable endowment portfolio, it's about 70% invested in stocks and 30% invested in bonds. And it's had a very remarkable performance start, both on an absolute and relative basis. Why? Well, if you break down, let's just say the S&P 500, which you're all familiar with, by the underlying 10 sectors, a sector might be technology, healthcare, industrials, energy. It just so happens that energy is the worst performing sector year to date in the index, as oil prices, as you witnessed earlier this year, really collapsed. And so by excluding energy companies, de facto, you're going to get better investment results, and that has indeed been the case so far. If you flip to the next slide, this is our sustainable non-endowment, also 70% equities, 30% bonds. And really the portfolios are managed in a very, very similar fashion. Also great performance here as well. So getting back to what I mentioned, my teaser earlier, we at the San Diego Foundation realize that those donors that are invested in our short-term portfolio have a bit of a conundrum today. They are essentially getting a 0 rate of return from the money market funds they are invested in. We have a number of donors that do not want to take any additional risk or any risk at all with their charitable dollars. And so the short-term portfolio will continue to exist going forward, knowing that there will be a time when short-term interest rates rise and there is some yield coming back into that portfolio. However, for the time being, after the San Diego Foundation deducts its fees from a donor's account invested in the short-term portfolio, they are seeing basically a net negative result, albeit small, every month. And through donor feedback we've received, we thought now might be the appropriate time to launch a new non-endowment investment portfolio. We plan to launch this vehicle on January 1st. It is called the intermediate term portfolio, and it sits really in between our short-term and our medium-term portfolio. The medium-term portfolio holds stocks. This particular portfolio will hold no stocks. It will be invested 100% in bonds or fixed income vehicles in the short to intermediate term maturity range. And our goal would be to generate yield through this bond portfolio we are creating that can partially to fully offset San Diego Foundation fees. That way, donors are not seeing a net negative every month on their fund statement. Now, a couple of things I just want to mention quickly. If you are a donor that is in the short-term portfolio and you do not want to take any risk with your charitable dollars, this is not going to be the portfolio for you. While bonds are risky, their range of outcomes is much tighter than stocks. So there is some risk involved that the value of this fund will go up or down over time, however, within a tighter range of potential outcomes. That said, we talked about how expensive bonds are today with interest rates as low as they are. And we're talking about a 1 to 2% type of rate of return coming out of this portfolio. So not all that compelling on an absolute basis, but in a world of zero or negative interest rates, 1 to 2% is quite a bit more than zero. So if you have any interest in this portfolio, it will be launching on January 1st. Please contact your donor manager and we'd be more than happy to share additional information with you. This is a quick teaser of what it will look like. So 60% in intermediate term fixed income, 40% in short term fixed income or bonds. And we have selected 3 investment managers. These investment managers are all bond funds that we're using in other San Diego Foundation portfolios. So we're familiar with these funds. We're familiar with their performance, with their teams, and with their process. And on January 1st, this is what we propose the portfolio will look like. Over time, as the portfolio grows in size, we may further diversify with smaller sleeves into other investment managers. Next slide. So with that, I am going to turn it back over to Brian Zambano to talk about our year-end giving deadlines.
Thanks, Matt. Thanks, Kevin. And thanks to you on the call too. Matt made a reference to feedback we received from our donors about their needs in the intermediate fund and why we launched it. Without naming names, some of those very donors in those conversations are on the call today. So I just want to say thank you for partnering with us, and thanks to Matt, Kevin, the investment committee, and others for responding this way and pivoting and being so flexible for this intermediate fund to respond to the changing of the market and making sure our donors get all the support they need to best support your philanthropy. So just thanks to everyone in that great outcome that we're seeing here. So as Matt mentioned, 'tis the season, it's year-end giving. As I'm sure you all know, because you're active philanthropists, this is the time of year where giving increases exponentially, and we at the San Diego Foundation are happy to support all those efforts, and things really ratchet up. So we want to make sure we're as communicative as possible with our fund holders about some guidelines on when dates you may want to get some things in so things can get wrapped up by year end. As you see here, our year-end giving guidelines are up. December 7th is the time that we request that grant recommendations come in. As you know, all grant recommendations go through a process on our end. We make sure your recommendation goes to a certified 501c3. There's a board approval and all that fun stuff, but that does take a little bit. So if you do want to get your grant to the nonprofit of your choice by the end of the year, it'd be great if we could hear from you by December 17th. December 28th is also a time for stock donations. As you all know, there's some processes involved with transferring stock and having them counting for charitable contributions. And then the rest are usual year-end, December 31st, last day of the year. So that is when things like credit card donations, checks, bank transfers, and wires come in. On the checks, the postmark is the key thing. So if you drop it in the mail on December 31st, it doesn't necessarily matter when it actually gets to the San Diego Foundation. We open the letter or deposit the check. That postmark on your envelope for a mail check, as long as that's December 31st or earlier, that is a year-end contribution for 2020. All of this information is on our website at sdfoundation.org/year-end. There, you'll also see contact information for our donor services team. If you have any questions about any of this, or you just need someone to help you or process any of your requests, please reach out to them. Our donor services team is available anytime during office hours, and they can be reached via email at donorservices@sdfoundation.org or by phone at 619-814-1332. Again, all that's on the link there, and I'll post that in the chat as well so everyone has it. So now we'll go to our Q&A portion of the webinar, and I will throw it back to Matt. If you want to submit your questions, use the chat function, and let's go. I'll throw it to Matt then. Thanks.
Thanks, Brian. So we did have a question come in ahead of time that is, I think, quite topical. And maybe I'll read the question and give a shot to the answer, and then ask Kevin to chime in as well. With increased COVID concerns heading into the late fall and winter, how do you seek to protect the portfolio's assets during this time? And, you know, I think that's a very fair question, as we're seeing record numbers of cases here in San Diego and really across the US. And, you know, I think it's really interesting. If you think back to what happened in the first quarter of this year, we watched the stock market fall at really an unprecedented rate. And I even hate to use that word unprecedented, because you can use it so many times this year. It's kind of cliche. But it really was an unprecedented rate at which the market was falling. And it really did look like, in a sense, the so-called world was ending. And then you had a policy response out of the Federal Reserve. And the markets turned around in certain areas almost immediately upon that policy response. And further fiscal and monetary policy responses followed. And as we talked about earlier, one of the big reasons why you know, markets perhaps turned around so quickly and re-accelerated upwards. So you have to be very careful about trying to time these things. We also know that there is hopefully a long-term solution here in the form of a virus, and that vaccinations are planned to start taking place in 2 weeks. So I would just caution everybody, sometimes, number one, the market tends to discount future outcomes. And so some of that may already be priced in to the market. And number two, you just never know what these policy responses are ultimately going to be. I do know Kevin has more to it, and it really involves the opportunity set and what's created as a result of you know, downturns in the market, should there be one. Kevin, you want to chime in?
Sure. I would just add, in terms of protection, the protection you put into a portfolio, you do primarily upfront in the way of very good diversification. So, you know, relative to COVID getting worse and doing more damage, for example, probably wouldn't be a good idea to put a big piece of your money into New York residential real estate. Maybe there are people who do it who are in that industry, but that's just an example of an asset class that has investment validity, but you wouldn't want to be overweighted to it going into this. You want to be as diversified as you can, and that's the trick, because you never, you never know really what the outcome is going to be from some type of a liquidity shock in the capital markets. To think that you could perfectly prepare in advance, I think, is naive. But what you can do, and what we are doing, is thinking about what types of areas might provide opportunity for investment should things get worse. We have, like I said before, the luxury of being very long-term investors. So to take that real estate example or lots of other examples, what kinds of investments are likely to be under some sort of distress if things get worse? And rather than trying to think that question through after the fact, we're spending some time thinking it through right now and developing some plans for what that might look like.
Thanks, Kevin. Yeah, I think real estate is a great example of that. There are areas of real estate that continue to thrive today. Think about industrial businesses that cater to the e-commerce market. I think we have an Amazon package, maybe even more than one, being delivered to our house every day at this point. And then you have areas like retail, where LA County is under a stay-at-home order. There are certain brick and mortar retail areas that were already under significant pressure heading into COVID, and that has just really accelerated. But typically what happens is there's capital flight in times of stress or distress, and capital becomes very scarce. And if we can come in and identify an opportunity where capital is scarce and be a capital provider, we're often rewarded with outsized returns on the other end. Will there be volatility on the way? Absolutely. But taking that long-term perspective allows us to ride through that volatility. So that is an area we're looking at very closely. I have another one here for you, Kevin. What will be the long-term effect of the massive fiscal and monetary stimulus on the global economy?
That's a good one. If I knew the answer to that perfectly, I'd be turning gold, or a straw into gold, I think would be the ancient example. You just can't know. If you look at what tips are doing right now, they're not really indicating much in the way of long-term inflation. And so on the one hand, there's a huge piece of the market right now that thinks that there's no way we can escape a long-term inflationary environment that probably leads to stagflation. Well, you sure don't see it in what the bond market is forecasting, neither in tips nor in yield curve. And you don't see it in what other global bond markets are forecasting. So I just think it's impossible to tell.
I think that's fair. And whether or not we experience the repercussions of this in our lifetimes tomorrow or not at all, it's very, very hard to predict and discount.
I would just add it's eerily similar to 2009, because the most common point of view when everybody realized the degree to which the government was going to inflate asset prices, when everybody realized that, the natural response was, let's protect our portfolios against inflation. Here comes inflation. And I heard it time and time and time again from all kinds of sources. So we're 11 years later. Anybody see any inflation? There has been inflation in asset prices, but certainly not the kind of inflationary environment that we all lived through in the 70s, for those of us who are old enough. That was a different experience.
Thank you, Kevin. I do not see any further questions at this time. So I will turn it back over to Brian. I'm always available in the office. If you'd like to contact your donor manager with any questions, we can certainly address those offline.
Well, thanks so much, Matt. Thanks so much, Kevin. And thanks so much to everyone for joining us today and for partnering with the San Diego Foundation, where we're leading change today for a better tomorrow. Today's presentation will be available on our website at sdfoundation.org/investments. And if we don't hear from you beforehand, I hope everyone has a wonderful holiday. Stay safe and have a wonderful day. Thanks so much.